All right. What's up, everybody? Welcome to another edition of What the FICC? What the FICC, man? I'm Spencer Israel here with Ian Cully, head of FICC at All Star Charts. Mr. Ian Cully, how are we doing today?
Doing excellent. Good to see you, Spencer.
Good to see you as well. All right, so let's see. Last week, what did we talk about last week? We talked about energy and we talked about commodities, more broadly speaking. Today, you just can't quit energy, or not you, maybe everyone, right? We can't quit energy, Ian. So we're talking natty gas and we're talking coal. Why are we talking about these things today?
Well, I think energy is just getting a lot of exposure right now from the media. A lot of analysts and talking heads, pundits are out there hitting on energy and the fact that energy could very likely outperform heading to throughout the back half of the year. We've been talking about that for over a month now.
I know.
And if energy, if you know Chevron and your Exxon are catching higher, then imagine natty gas and other areas that are often overlooked, like coal stocks, are probably catching higher as well. So I wanted to highlight these areas of the market that I haven't gotten to in previous weeks.
All right. Well, yeah, certainly we have not talked about natty gas in a second. It does seem like we talk about coal a lot, but let's bring up the natty gas futures charts. Here we go. All right. This is the main way that most people play natty gas, correct? Or I guess one of the two main ways. What does this chart say to you?
This chart says to me that natty gas is bottoming at a logical level, an area where it has bottomed over the past decade, especially coming off this steep decline last year. I think natty gas is putting in a logical base here. It just makes sense, and positioning based on the large spec and commercial COT positioning. It looks like commercials are beginning to unwind a historic long position in natty gas. So as natty gas sold off, actually, I think that sell-off really kicked off in this year, in January of this year. They keep selling off. Commercials were out there scooping up, buying natty gas hand over fist like they never have before, because natty gas was on sale. That's what this chart tells me. And now they're starting to take profits. They're starting to unwind. And this type of unwind, has a tendency, as you can see here, back in 2016 and 2019, this unwind kind of led to a more significant unwind through 2020. It's what moves markets. This potential unwind could be the catalyst for the next rally. And it's coming as volatility compresses. Markets have a tendency to constrict or contract and expand. Contract and expand. That's where we get the consolidations and the rallies or sell-offs. Here we're looking at consolidations and then a rally through 2021, and it's consolidating again now. Will we get another rally? Well, the 4-week rate of change is really quieted down, much like it did in 2020. There's other ways to look at this. We also look at the ADX. This is the average directional movement index. And what this is basically telling us is a market trending or not. And usually reading below 20, you can drop it all the way down to 15. If you get a reading down in the low teens or around 11 or 12, that's an indication that a market is not trending, right? Above 15, above 20, you get these strong trends. You can see that in the middle of 2021 as this rally really took off in natural gas futures. So did the ADX here in the bottom pane. But today, it's registering 13. That's because the market's not going anywhere. It's contracting. Volatility is compressing. And you can see it again here with the Bollinger Band width. I'm just showing you different ways to point to see and understand what's going on in price action in terms of not trending and trending and when volatility contracts and when it expands. Right now it's contracting, and those contractions often lead to expansions in price. And it just so happens that we're entering probably the best period of the year, the strongest seasonal period of the year for natural gas.
So interesting. That's so interesting how the strongest season of the year for natural gas is also the weakest season of the year for stocks, right?
Yeah, that is interesting.
Yeah.
That is
Funny
interesting.
Funny how that works out that way. All right. So volatility is really coming in here into what is historically usually at least a strong time of the year for this asset. Doesn't mean it has to be the case every year, but usually, right? That's what seasonality says. So those are really, if I'm getting you correctly, the two main reasons amongst the chart itself that you're bullish here.
Well, it stopped going down at a level that has acted as I won't say support, but an area of the chart where natty gas has a strong tendency to bottom and reverse higher. Right, we got that. Volatility is contracting. Right, the market is no longer trending. It is chopping sideways, and in that process, it is carving out a constructive basis. Right, commercial positioning beginning to unwind. Like that's a catalyst that could really get this rally going. So there's a lot going on as we head into what is a seasonally favorable period for natural gas. And just look at the price charts.
Yeah.
I mean, we've got some failed breakouts or maybe some premature breakouts over the past week, late last week. I guess getting a lot of emails. A lot of readers were getting excited about this breakout in natty gas. It's not quite materializing here on the continuation chart. And I still like that, 283, 285 level, above 285, and I like it long, easily back up towards 5. I don't think it'll take much to see natty gas catch higher there in the coming months. Here's UNG, another great way to play natty gas. I think above 750. I know this is really messy. It's a really messy chart here.
Yeah, this is gappy as all hell.
Yeah, well, I mean, you got to understand that the underlying asset that natty gas or the UNG fund trades practically 24 hours.
Yeah.
Right. So this is a pure play on a market that is open, all day versus a market that's only open a handful of hours a day.
Right. So just to reiterate that point, UNG as a US listed what is it, technically an ETN? Maybe, I'm not sure. Anyway, as a US listed security, is it going to trade US market hours as opposed to the natural gas futures market, where the futures have much longer hours, and so there's going to be times when one market is closed and the other market is open, and when the UNG market reopens, it has to account for the movement in the overnight session in the natural gas futures, and to create some gaps as you see on this chart, and it can look kind of funky.
Right, exactly. So natural gas futures, they open Sunday evening.
Right.
And they only close for an hour in the afternoon, Monday through Friday, to adjust and settle a closing price. So yeah, I mean, that's exactly why you're seeing all of these gaps. Regardless, natty gas above 750. I'm gonna call it $8. I think it's running back up towards 10. Talking about UNG. And it's a comparable level to this $5 level here in the futures, 16 for the natty gas fund, UNG. But looking at the individual natural gas contracts, I believe September is most actively traded.
Wait, actually, before you get into this, I do have a quick
Yeah.
general futures question for you.
Mhm.
What when you trade futures in any market, what contracts are you trading? Do you trade the just the front month? Do you trade
Yes, I
the
I just stick with the most active.
okay?
Whatever's the most actively traded. Yeah, absolutely.
And what is that for natty gas right now? Is that
September.
September? Okay.
Yeah, it's September right now. So we got a failed breakout here again last week, and it is resolving. It is slipping back into its prior range here below 277. If and when natty gas gets back above that level, I think 350 is a logical area of potential resistance, getting back up towards those early March highs. You can also look at the December contract. December is a very active contract. It's breaking out and it is holding above that breakout level and consolidating. So I like to see that as constructive. If you want to go further out, and if you want to trade natty gas back towards the end of the year, not have to worry about rolling that contract from October to November to December. I like it long above 372.
Wait,
It's also interesting.
I have a silly question. I probably should know this, but I've never actually bought, I've never traded a future before.
Mhm.
Do, can you buy like the continuous and have it roll automatically, or no? You have to buy a specific
No,
contract. Okay.
no,
We
no.
so
I don't think you can have a contract roll automatically.
we only look at the continuous chart for the sake of convenience, but that's not a thing that you can ever do. You can only ever buy 1 month, and then you have to roll it yourself.
Yeah, exactly.
Okay. Okay. Got it.
Exactly.
Okay.
So, yeah, and that's a really, you kind of bring up a very interesting point. So you have a continuation chart. That level's 283. Let's go to 285, right? That's the level here on the continuation chart. Above that level, I think we could safely say that demand has absorbed all of that supply. We got a breakout. When we look at the September contract, is it 277?
Yeah, that's weird.
So that's it raises a really interesting point where I always trade the individual contract, and I want to see a breakout on the individual contract. I'm not crazy about getting long any individual contract, no matter what the commodity is, without confirmation of a breakout on the continuation chart. Does that make sense?
Yes, it does.
Okay. I get a lot of
Okay.
questions about that all the time, about whether or not, like, which do you trade? What's more important? I think the individual contract's the most important, but again, like, I always like to see the confirmation on the continuation chart.
But you're looking
Talking,
at you're looking at the front month chart as, because that's the thing that you're actually trading. That's the one that matters most.
yes,
Yeah. Okay.
yeah, goes back to, like, you just trade what's in front of you. Another interesting point, an interesting kind of intermarket relationship where I'm looking for some confirmation is Minneapolis wheat. Now, wheat and crude oil have a strong positive correlation. It's interesting to see that Minneapolis, the spring wheat contract, has really strong correlation over longer time frames, of course, with natural gas futures. I just think it's so interesting to see that the fibs are lining up. That they're reacting to these same levels. Both natural gas here in the bright blue, and Minneapolis wheat in the darker navy color here. The question is, will Minneapolis wheat stop falling? And that's kind of what I'm watching here. I'm watching the front month here. We'll probably roll here in the next week or so. for Minneapolis spring wheat. But, if spring wheat breaks below 775, I mean, that's, it's just, a yellow flag. It doesn't kill my bullish natural gas opinion or bias. But again, that opinion isn't a position. Like, I don't have a position in natty gas until it breaks out, like the December contract.
Okay. That's a weird relationship there. I don't know.
It is, and it's a funky
I
looking chart too. It's
I
a
don't know
really
if I
funky
would've.
looking chart.
Yeah.
I was trying to figure the best way to display the information without it looking so messy, and still looks really messy.
But before we move on to call, there was a question in chat about natty gas stocks. We don't have any charts handy, but names like LNG and
Cheniere.
the right Cheniere, Kinder Morgan, right, W Williams Company, WMB. What else? EPD, I think, is one. Energy Transfer, ET. Do you look at any of those? Do you have any opinions there, or again, are you mostly just sticking to the futures here?
When it comes to natty gas, I just really like trading UNG. I like the pure play, because the risk reward is so heavily skewed in our favor. And I'd rather, this could be looking at a double in UNG. I like that. This is where I want to focus. There's plenty of great trades out there in the natural gas names. I'll share some of those in the coming week. Cheniere has just been an absolute beast. It was a great trade over the past year or two, 2 years. But when it comes to trading natty gas, I'm more focused when it comes to the equity markets, UNG.
And then Jonathan just asked about FCG, the natural gas ETF. I'm gonna look at that one for a second here.
Yeah,
I don't think it's very large. Let me see.
Yeah, but a lot of those names in FCG are have exposure to gas, but are also big oil names. So it looks a lot like XLE.
Yeah, that's a really good point. Since you mentioned that, I'm looking at FCG right now, and it has oh, it doesn't break it down by industry, which is sort of annoying, but yeah, it's got a lot of energy. Just look at the holdings in this thing. It's got ConocoPhillips, right? It's got Hess, Occidental, Marathon. So it's more of a broader, even the name says natural gas, right? But you gotta look.
I made that mistake before. And I dug into it. I'm like, oh, wait a second.
No,
these aren't really natural gas stocks.
Always read the ingredients. That's true. Yeah, it's true if you have food allergies and are investing in ETFs.
Right.
Okay, let's move on to the other half of this equation here. Let's talk about coal.
I don't think. Maybe we talk a lot about coal. I know Steve loves a lot of these coal stocks.
Yeah.
But I don't think investors are aware of coal, or I definitely don't hear it on the airwaves as much.
Yeah, no, you don't.
And that's why I wanted to bring it up. And I love this chart from JC. He tweeted this recently. And in the black line, we have the VanEck Coal ETF, KOL, delisted in December of 2022, right before, actually no, it was December of 2020, right before it just went on an absolute epic rally. At least coal stocks went on an epic rally. Coal, the ETF, didn't do anything because it no longer existed. Ian? How do they manage? How do they? I mean, the timing is impeccable. It happens all the time.
I don't have any data on this. I would love to get some though, because this does happen a lot, where an ETF languishes for years on end, and they shut it down, and they pay out everyone who invested gets their money back, and then only after the fund closes does the the market rips higher, right? And whenever it was invested in, and it happened with coal here. It's happened with several other ETFs that I can think of off the top of my head, and it just seems like it happens quite often. I don't know why.
We just, we pointed out all those Bloomberg commodity ETFs were delisted recently. I don't know exactly, the reasoning behind it. Wasn't necessarily because it was, falling apart. But I'm sure there's got to be a magazine cover somewhere out there from mid 2020 claiming that coal is dead.
Yeah.
Guaranteed.
Yeah. For sure.
Here we go. This is our coal index because no longer existed. The ETF was no longer there. We created our own. This is Alfonso threw this together. Equally weighted coal index with BTU, ARCH, AMR, ARLP, HCC, CIX. See all the tickers here. I'm going to go through all of these today, except NRP. So we take just a quick look of, underneath the surface, because this is a great looking consolidation. Index is contracting and building up energy before it expands. Right? A lot like natty gas right now. So I really like buying coal, long coal, especially if this index is breaking to new highs. First up, Peabody Energy. Lower bounds of year and a half range. I think we could trade this against the 1850 level. If you want to buy, weakness back towards 1850, excuse me, with an initial upside target around 30 back towards the highs of the range, with the understanding that we could be heading back up towards 50, towards those 2018 highs. If energy is really going to get going heading into Christmas, I imagine Peabody Energy, BTU, is going to be trading above 30, heading back towards 50.
All right.
Here's Consol Energy, CEIX. This is a $2 billion thermal coal stock, and it's already breaking out.
Look at this one.
I know this. It's a great looking chart. This is the CEX is the chart that JC used here. New all-time highs when he was overlaying it with the Van Eck coal ETF that no longer exists. We don't need it. We got CEIX. Look at long above 75, targeting 120. It's in a bullish momentum regime, and it just printed an overbought rating. I like seeing that on breakouts. Sunchoke Energy, SXC. Tough one there. $750 million thermal coal stock. It's less than $1 billion. I know a lot of us tend to shy away from individual stocks that are sub $1 billion in market, sub $1 billion in market cap. But a lot of these names across the coal space have been absolutely beaten up. We got to remember that they delisted the coal ETF. So, I like taking a swing at Sunchoke Energy XXC, even though it's not $1 billion. We have a trend reversal here, potential trend reversal underway as it, violates this multi-year down trend line. When we zoom in, we got a potential cup and handle here. Potential cup and handle. So if and when SXC, Sunchoke Energy, is back above $10. It's about $10. I like it towards $12.50. Secondary objective up around $16.
All right. Zach Hess in the chat asked about this next one, and I goofed. I was like, I saw the name. I was like, we're not talking about metals, but that's not what AMR is.
No, AMR is a metallurgical coal. Okay, so there's many different grades of coal, but when we're playing coal names, we can really just break it down into thermal coal stocks and coking coal or metallurgical coal stocks. One for energy, obviously. The other for producing steel and base metals. So what's really interesting is that I think the cheat code is you're buying a coal stock and the second part of the name is energy. It's probably thermal coal. If you're buying a coal stock and the latter part of the name is resources, probably coking coal. Here's a coking coal stock, $2.8 billion AMR. Look at that trend, Spencer. Look at that, respecting these Fibonacci extension levels. And what's interesting here is sometimes you see as it ripped through that 2150 level, sometimes it rips right through our level. It's right past our level. Market, as if the market doesn't even care that it's there, but then pulls it back and finds support. You see it do that at that 2150 level. We see it rip right through 3381 and not even look back. Right now, it's finding support at a key level around 136. Let's call it 140. And when we zoom in, it's breaking out. AMR is breaking out. As long as it's above 170, let's call it 180. As long as it's above 180, I like it long towards 225. Secondary objective all the way up toward 300. So you're seeing here, we got that 222 here. Rough estimate here for our extension, our 161 extension. And it lines up with that 220 here.
Yeah.
On the longer term chart.
We got a couple more.
Alliance Resources Partners, ARLP, digging in at a logical level of support around 1750. I like trading it against that level, by any weakness back towards 1750. If it's below that level, all bets are off. Initial objective, 2650. Secondary objective around $40 in a bullish momentum regime. Gotta like that. Warrior Met Coal, false breakout earlier this year. If and when it can get back above, let's call it $42. If and when HCC is above $42, I like a long initial target up around 50, secondary target up around 70. Last but not least, Arch Resources, ARCH. Yes, this is a metallurgical coking coal stock. Digging in at those former 2019 highs, the 2018 highs, a prior cycle peak. Also coming in around this level, around 101.
This looks like there's kind of nothing to do here.
There's really nothing to do here. Exactly. Good point. Because it's in the middle of its range. So I like waiting until we get an upside resolution above the shelf of former highs around 170. If Arch is above 170, it's probably catching higher along with the rest of the space. And what's also interesting I want to point out is that you can see as it consolidates, this is the ADX showing you earlier, trend identification, and it is identifying that the trend is sideways. So market is contracting, building up energy, and for a potential upside resolution.
Okay. I think that's a good place to wrap it up on What the FICC today. I want to mention everyone that, of course, the show airs every single Wednesday and Friday at 11:30 a.m. Eastern time. However, if you want more, this isn't enough for you. For example, we don't really do hardly any Q&A on this show. If you want to ask Ian questions and have him personally respond, the only way to do that is to sign up for All-Star Charts Premium, which you can do by emailing us. The email is on the bottom of the screen, questions@stockmarketmedia.com. You can also call the number on the screen. It'll be there in a second if it's not there now. 323-421-7910. Talk to Mary, get an account at All-Star Charts Premium, and then you can get access to all of Ian's research, his charts, his decks, his private videos he does just for the members. So check all that out there. And that's a wrap, I think. So any final thoughts?
No,
I think we're good.
Just manage risk. It's,
Manage
it's
risk.
still really choppy out there. We were just on a call internally, debating on the direction of interest rates. There's still a lot of mixed messages out there.
Yep.
So always
sure.
play it safe and focus on risk management.
All right. We'll see you guys on Friday. Options trade of the week coming up next. Stay tuned for that. Have a good one, everyone.